Okay, so Spokane's apartment market looks like it's finally, maybe, pulling out of the deep end after a pretty rough patch.
Yeah, that's the big headline. After that challenging run of rising vacancies, Q3 2025 really confirms a significant rebalancing.
And maybe a sudden one. That 9% vacancy peak felt pretty painful not long ago.
It did. But it seems to be firmly in the rearview mirror now. It was fueled by, well, a record wave of demand. That's what stabilized things so quickly.
Welcome, everyone, to the deep dive. This is where we take those dense market reports and, pull out the critical knowledge you really need.
Helping you stay ahead.
Exactly. Today, we're diving deep into multifamily real estate, and we're focused specifically on the Spokane, Washington market for Q3 2025.
That's right.
Our goal here is pretty simple. Give you the crucial trends, the investment insights, all in under 15 minutes.
And we should be clear, all the figures we're talking about today, they're sourced directly from the comprehensive Q3 2025 market report. No guessing here.
Absolutely. Now, if you need context that goes deeper than what we cover, or maybe analysis on a specific asset, you can always reach out directly to Eric Peterson. His number is 509-903-9077.
Okay, so let's kick off with the quarter in, say, a minute. Just the key headlines from Q3.
Perfect. Hit us with them.
All right, first up, vacancy. The overall rate as of early October stands at 7.4%. It's a really dramatic drop from the 9.0% peak we saw back in 2024. It confirms the market stabilized after that big surge in new supply.
Okay, 7.4%. Got it.
Second, demand and absorption. This is really the main story. Spokane saw record-setting demand. We measure this through absorption. That's just the net number of units leased up versus vacated.
Right.
Over the past year, absorption hit 1,600 units. That basically matched the amount of new supply delivered. Huge number for Spokane.
Wow, okay. Match the supply. What's third?
Third, supply. Construction activity. It's decelerated sharply. I mean, down a staggering 80% from its peak in 2023.
80%?
Yeah. Right now, only about 640 market rate units are actively under construction. This sudden sort of choking off of the pipeline, that's probably the most critical factor going forward.
Huge shift. Okay, number 4.
Fourth, rents. Asking rent growth looked pretty sluggish, only 0.8% year over year overall. But look, don't let that number fool you.
There's a catch.
There always is,
Yeah.
right? The high-end luxury segment is actually showing clear signs of recovery. That overall figure. It's heavily masked by the use of concessions and incentives.
Okay, we'll need to unpack that. Anything else for the quick headlines?
Just the takeaway. If you remember one single thing from this report, it's this. The massive slowdown in new construction. That's the #1 factor rebalancing the Spokane market right now. It creates a future supply constraint that, well, it favors existing landlords.
All right, let's dive into that first big positive movement then. Vacancy and the demand driving it. That 9.0% peak was definitely painful for owners, but the quick drop to 7.4%, that suggests a massive correction.
It does.
Now, 7.4% is still a bit above the long-term average, right? I think the report said 5.8%.
That's correct, yeah. Still elevated compared to the 10-year average.
So what makes us confident this downward trend is, sustainable and not just a blip?
It's the sheer velocity of the drop. The rate of decline is the real headline here. And it was entirely driven by that record absorption figure we just mentioned, 1,600 units leased up in the last year.
That's incredible.
It signals that the underlying demand in Spokane is just incredibly robust, whether that's from local job growth or, maybe more likely, continued migration from higher-cost places like Seattle or Portland.
And it's fascinating how that demand played out across different types of properties. You often assume the brand new buildings struggle the most initially.
Right.
But the report suggests the luxury tier, the 4- and 5-star stuff, actually led the recovery here.
It absolutely did, which might seem counterintuitive. That segment saw the sharpest recovery. Its vacancy fell from over 13% in 2024 down to 9.7% now.
Still high, but a big improvement.
Exactly. Still elevated, but look, that segment was hit hardest by the supply wave. So its ability to absorb that supply so quickly is a really clear signal. It shows the high-end product is finding renters.
Even if it takes some deals to get them in the door.
Precisely. Even if it requires some temporary concessions to, seal the deal.
And we're seeing this correction geographically too, right? Like the areas that maybe got a bit overbuilt are now the ones soaking up units fastest.
That's spot on. Submarkets like North Spokane, South Spokane County, places that saw the biggest influx of new units and the highest peak vacancies,
Yeah.
they're now seeing the most rapid improvement in leasing velocity.
So the market's clearly past the worst of it, vacancy-wise.
I think that's fair to say.
Yeah.
Definitely past peak vacancy for this cycle. The continued lease-up of those recent deliveries, plus the minimal new construction we're seeing now, it just means vacancy should keep trending lower through Q4 and well into 2026.
Okay, now for what you flagged as maybe the most interesting part, the supply side. An 80% drop in construction starts. I mean, that sounds less like a slowdown and more like developers slamming on the brakes.
Yeah, hitting the emergency brakes isn't far off, honestly, given the numbers. Construction starts are down roughly 80% from that 2023 peak, which was nearly 3,200 units.
Wow.
Today, we have only 640 market rate units actively under construction across the whole market. That level of pipeline activity, it's the lowest Spokane has seen in, well, over a decade.
So what caused such a dramatic pullback? It can't just be the temporarily high vacancy rate we saw last year.
No, it's more than that. It's really a triple whammy.
Yeah.
First, you had that prior period of pretty sluggish rent growth, which hurt projections.
Yeah, okay.
Second, rising construction costs really started hitting their their projected profitability.
It made the math harder.
Exactly. And third, significantly tighter financing conditions, higher interest rates. Developers just couldn't get many projects to pencil out anymore.
Right. Makes sense. So if new supply is basically stopping, that sounds like great news for established owners down the road. But what about the owners who, just delivered a property in 2024 or early 2025? Are they feeling relief yet or still struggling?
Well, they are seeing steady lease-up velocity. The report pegs it around 15 units per month for new projects, which is pretty decent.
Okay.
But that speed is still being bought with incentives, concessions, sometimes, 6 weeks of free rent, maybe even more. They remain pretty common in those new competing assets.
So it's a trade-off.
It's the classic trade-off, speed of lease-up versus reduced income, at least initially. And that's obviously a significant drag on operating margins for those specific owners of newly delivered properties.
Still, it's good to know there's still some long-term confidence out there. The report mentioned one notable exception to the construction slowdown, right?
That's right. Despite the overall very cautious environment, Fourth Avenue Capital actually broke ground on a new project. It's the 240-unit single-point apartment homes out in Liberty Lake. That started in August 2025.
Interesting timing.
Yeah, it highlights a developer showing real long-term conviction in Spokane's fundamentals. They're essentially betting that this current slowdown means they'll be delivering into a supply-starved market in a couple of years. A calculated risk.
Okay, let's pivot now to rent dynamics, because this feels like maybe the murkier part of the report. Vacancy's falling sharply, demand's at record levels, yet asking rent growth is still kind of sluggish at just 0.8% year over year.
Right.
Why aren't we seeing rents really pop yet? Is this absorption wave temporary, or is it just fueled entirely by unsustainable incentives?
That's the million-dollar question, isn't it? And the answer lies almost entirely in those concessions you mentioned.
Ah, okay.
Think of it like a car dealership, right?
Yeah.
The sticker price is the asking renter. It might look pretty stable.
Right.
But if almost everyone is getting a significant rebate, the concession, then the true price the landlord actually takes home, what we call the effective rent, that's the real measure of the market.
So the incentives are hiding the true strength.
Exactly. The pervasive use of those incentives is definitely suppressing the headline asking rent figures. Now, that said, there's good news baked in there.
Okay.
The recovery is leading the way in that higher-end 4- and 5-star segment. It's actually up modestly year-to-date, actively recovering from the rent declines they suffered when their vacancy peaked last year.
So the top end is firming up first.
Correct. And effective rent growth overall, which tries to strip out some of that concession noise, it's slightly higher than asking rents, clocking in at 1.1% year over year. Still modest, but pointing in the right direction.
Okay. And what about the bedrock of the market, the more affordable, cost-conscious segment? How's that holding up?
That segment remains incredibly stable, really resilient. The most consistent growth, actually 0.7% year over year, is found in the 1- and 2-star segment.
Makes sense.
Yeah, it's supported by really robust demand from renters who are prioritizing affordability above all else. Spokane Valley is also seeing the strongest asking rent growth geographically. But again, the report flags that concession usage is still high there because of all the new construction they saw previously.
So the underlying expectation is pretty simple then. As this current wave of new supply finishes leasing up, the concessions should start to burn off.
That's the theory.
And that should translate directly into accelerated true effective rent growth in the near term.
Precisely. The runway seems clear for pricing power to return to landlords, especially with that construction pipeline drying up.
Okay, good. Now let's turn to the money side, capital deployment. Sales volume is up from its low point in 2024, which is positive. But how are investors deciding where to put their cash? Are they chasing those brand new, shiny core assets, or are they buying older properties to fix up the value add strategy?
Right, good question. Overall volume is recovering. The 12-month trailing sales volume stands at about $131 million, which is better, but still a bit shy of the historical pre-pandemic average, which was closer to $150 million annually. Private investors are still dominating the activity. They account for roughly 80% of the transaction volume.
Still mostly private buyers, then.
Yeah. And we definitely saw a clear pricing separation based on the risk profile of the asset.
Give us an example. What did a core deal look like?
Sure. So on the core side, think stable, newer institutional-grade properties. Northridge Capital bought the newly built Riverside Lofts. That's downtown Spokane. It happened back in April.
Okay.
It's a 112-unit, 5-star property, and it closed at a very tight 5.7% cap rate.
5.7. Wow, that is tight in today's market.
It is. A low cap rate like that signifies a high price per unit and lower perceived risk. It's consistent with premium pricing for those absolute top-tier assets.
Okay, so that's the high end. What about the value-add candidates? The maybe slightly older, stabilized three-star stuff. That's usually where the private capital focuses, right? Looking for some operational upside.
That's definitely the private capital sweet spot. We saw Evergreen Equity Partners acquire Maple Ridge Apartments out in Spokane Valley. That's a stabilized 96-unit, 3-star asset. That deal closed in June.
And the cap rate there?
A bit higher, as you'd expect. It closed at a 6.1% cap rate. And interestingly, the buyer specifically cited Spokane's resilient demand and, crucially, the limited new supply pipeline as key drivers for their investment.
So they're buying into that future supply constraint story.
Exactly. It shows buyers are willing to, pay a bit less per door for assets needing some renovation, which results in those higher starting cap rates. But they clearly believe the local market fundamentals support future income growth.
Makes sense. Any really big deals specifically in Q3?
Yeah, the largest single deal recorded just in the third quarter was the sale of Eagle Rock. That's a 210-unit property. It closed in August for $36.8 million.
Okay, and per unit?
That translates...
Got it. Okay, shifting gears slightly to the broader capital markets picture. We just mentioned those cap rates. For anyone listening, the cap rate is basically the initial rate of return on buying the property. The shift we've seen from maybe the upper 4% range before 2022 to where we are now, that's a massive change.
It's critical change, yeah. Before 2022, when interest rates were practically zero, you saw investment-grade multifamily cap rates, often in the high 4s, sometimes even mid-4s.
Right, crazy low.
Now, they're trending definitely toward the 6% mark overall, maybe even a bit higher for some assets. Higher interest rates simply push the cost of debt up for buyers.
Which forces property prices down to make the deal work.
Exactly. To maintain a positive spread between the cap rate and the borrowing cost, prices have to adjust downwards, which naturally raises the cap rate. Recent stabilized sales are closing mostly in the low 6% range. The overall average cap rate mentioned in the report was 6.3%.
And even though pricing seems somewhat stable quarter to quarter now, there's a clear signal that buyers are still being very careful.
Oh, absolutely. The data shows clear buyer hesitation. Tighter underwriting standards are definitely in play. You see it in the difference between asking price and closing price.
How big is that gap?
Properties, on average, are trading at a discount of 8.1% to their original asking price.
8%?
Yeah.
That's significant.
It is. It signals that buyers are demanding that cushion, that margin of safety, because of the elevated interest rates and just the overall pressure on valuations across the board. The typical price per unit seems to be settling in that $150,000 to $200,000 range for average product.
Okay, so let's try to pull this all together for the listener. We've got vacancy down sharply, new supply is dramatically choked off, rent acceleration seems poised to happen as those concessions burn off. What should investors and operators really be watching for as we head into Q4 2025 and early 2026?
Well, the immediate outlook seems pretty positive, fundamentally speaking. Continued tightening. With fewer new units entering the market, we should expect further vacancy improvement.
And hopefully, pricing power returns.
And a return of pricing power for landlords, yes. Spokane seems well-positioned now for moderate, sustained growth, especially coming off the volatility we saw in the last couple of years.
What's the main risk you see to that positive forecast? Is it all those units that are still technically proposed but not started?
That's certainly a watch item. The report mentions over 1,000 units are proposed in the pipeline. But given the current conservative underwriting environment we just talked about,
Right, the financing and costs.
yeah, it means most of those are probably unlikely to actually break ground anytime soon, which, ironically, helps maintain that limited future supply environment that supports the recovery.
Okay, so maybe not an immediate risk. What else?
I think the larger, maybe longer-term risk relates more to the broader economy and specifically affordability. Spokane's growth has been fueled in large part by massive immigration. People moving there because it was affordable relative to Seattle, Portland, other West Coast cities.
That advantage is shrinking, though.
It is eroding, yeah, due to these rapidly rising housing costs, both rents and for sale prices. And while Spokane has decent job growth, the report notes it's concentrated in typically lower wage sectors like healthcare and leisure.
So the gap is widening.
Potentially. If housing costs continue to outpace the growth in local median household income, that could eventually temper demand and slow down that immigration in the long term. That's the balancing act.
Yeah, that really feels like the core tension defining the Spokane market right now. Its long-term strength has relied on that affordability edge within the Pacific Northwest, but that balance is getting harder and harder to hold as housing costs surge everywhere.
It's a key factor to watch, absolutely.
Well, this has been a fantastic deep dive, and just a reminder, it was derived entirely from the comprehensive Q3 2025 multifamily market report for Spokane.
Lots of good data in there.
Definitely. And if you need further detail, perhaps a custom market breakdown for your own needs, you can contact Eric Peterson directly. Again, that number is 509-903-9077.
He's the person to talk to.
He is. Thanks again for diving in with us today.